I think this is interesting because this goes along with your expectation too. A top in 2026 or maybe the end of 2026 to then last all the way, as we can see there, the bottom is the 2032, early 2030s. Do you have any thoughts on this?
A lot of people are predicting S&P 6,000, which it may happen. And
Yes.
I said, we're predicting Dow 6,000. Okay, so
Yeah.
yes, we're really, really bearish. So I think this being the biggest one of all, the downdraft could be stunningly swift, like a year or two. I think they're right. I've been
okay.
I've been too bearish, no question about it.
This is really fascinating to me, Bob. And I think a lot of our viewers and subscribers to our YouTube channel have seen this before. I've made a video on this. This chart actually supports your overall bearish case. Now, this is a Benner cycle, as I'm sure you know, Bob. Samuel Benner devised this cycle back in the late 19th century. And a lot of his calls actually back in over 100 years ago were correct. He called the 1930s Great Depression. He got it wrong by about a year or two, but essentially he was right. As you can see, 1927, the market crash top occurred in 1929. 1945, 1965, these are all correct. The biggest one to me that's interesting is the dot-com crash. He was absolutely correct about. By the way, these years, Samuel Benner said these mean the completion of the years, not the beginning. So when we see these years, I just want to make sure our YouTube viewers know this. The years do not mean the beginning of those years, it means the end. So, for example, he called the end of 1999 being the top, very close to the dot-com bubble crash, which lasted all the way to the 2000s, early 2000s, and the 2007. Yeah, there it is right there. The 2007 top, which then dropped and crashed. That was, of course, the Great Recession, as we know. And the end of 2019, that would be the COVID one. But you can see here, according to his cycle, 2026, the end of 2026 is his view, was his cycle top for the stock market. By the way, it could be a year or two off. But I think this is interesting because this goes along with your expectation too. A top in 2026 or maybe the end of 2026 to then last all the way, as we can see there, the bottom is the 2032. Early 2030s. Do you have any thoughts on this? I just find this amusing. I mean, it's okay if you don't have anything to say about it, but I just wondering if you have any thoughts on it.
Sure. In the back in 1978, A.J. Frost did a version of this very chart.
Really?
He called it the Benner Fibonacci chart because he found he offset it slightly to fit certain Fibonacci periods.
Yeah.
Now you can also look at this chart and look at the major bottom in 1985. Now, that was off by 3 years.
It was, yeah.
At the same time, in September 85, I remember like it was yesterday, I was the only bullish advisor in September 85 in the market vein tally. I thought it was a series of ones and twos on the upside. Mm-hmm. And everybody else was saying, oh, it looks toppy, or it's blah, blah, blah. I said, no, man, this is getting ready to go vertical on the upside. Like I said, all the advisors were extremely bearish at that time. So Benner kind of had it right in a way. People were still really, really negative in September of 1985. And then the market absolutely took off on the upside. Yeah. So and if you look at the 2012 low, that was off by 3 years as well. Because
it was, yeah.
Bottom in 09. But as I mentioned in our earlier discussion, that was also the low in real estate was in 2011, 2012. The low in Dow Gold was in 2011 as well, and kind of stayed around that area until late 2012. That's when gold topped out. And we said at the time, last chance to sell your gold. So everything is counterintuitive. Yeah. I think this Benner thing is pretty interesting, but I would not bet all my money.
Sure.
In 26, maybe we top in 2024 and we do a 1 down and a 2 up for wave A in 2026, and that's when the real crash happens. I mean, all kinds of possibilities when you study the Benner chart and what happened in reality. Yeah. I still say all my toys are in the front yard. You can play with them. I'm not going to play. I'm not going to play. I couldn't be less interested in owning a single share of stock. And in fact, I think if you're bold, you should every now and then be betting on the downside when things are extreme on a short-term basis, on a 5-day basis or something like that. So even though you've got, numbers up at 2 years from now as a likely top, I'm just going to stick with saying, we're bearish right now. Tops in October are not very common, but there's one that I remember quite well, which was October 1973.
Yeah,
The Dow got back very close to its all-time high from January, and people were calling for new highs. And you can kind of liken that to the NASDAQ 100, which topped in July, still hasn't
sure.
been. So you don't get it very often, but I tell you what, when the one time it did happen at an October top, the decline was very swift in November,
Yes.
December of that year, and of course led to the big bottom of December 1974, 14 months later. So all these things are kind of they're interesting. They're interesting. Is it seasonally this? We're in an election year. Does that matter? Benner cycle, a 4-year cycle. But they're really just talking points. And I think the extremity of optimism and the struggling recently of the market to make new highs, from October 14th through yesterday, you've had different indexes make rally highs.
Yes.
The NASDAQ 100, I think, was on the 14th. The NASDAQ Composite was yesterday. And then we had the Dow in the middle of that on October 17th, if I recall, and the S&P, a couple days later. So they're all kind of hitting highs, and they're spreading it out a little bit. And they might overcome it, but to me, that's an exhaustion kind of signal.
Is it correct that once this bull market tops, which I think you are correct, I think a lot of people who criticize you, they don't understand. They're very impatient because, oh well, you said this last year. They don't really get the whole thing. They don't understand the big.
Oh, look, I think they're right. I've been
okay.
I've been too bearish, no question about it. But I think it's been a practical and reasonable bearishness, given the entire, not only the structure but also the background of everything that we've talked about.
But essentially, just to finish with this point, with this question, is it correct? I have this correct that your view is that when eventually we fall into a bear market, sometime in this decade, probably, and when this crash eventually begins in the next several years of this decade, again, not now, probably, but sometime probably could begin in the next few years. And eventually this big major crash, people are probably wondering, okay, but how low can we fall? How much of a drop are we expecting? Am I correct that you're expecting the Dow to drop below 2,000 to about 1,000 on this chart? So it's going to be a heavy drop. I mean, we're just over 40,000. We're approaching 45K approximately. But am I correct in saying that your expectation is that for a longer term reversal, downtrend, bear market to fall below 2,000 on the Dow? Am I right?
Your chart here, you see where you have your blue 4?
Yeah.
That was Dow 6,000.
Uh-huh,
so what I've said in recent issues is a lot of people are predicting S&P 6,000, which it may happen. And I said, we're predicting Dow 6,000. Okay, so yes, we're really, really bearish. And it's hard to say because as I said earlier, we are dealing with a measuring unit that's completely elastic. And if they screw up the measuring unit, it may never see those low levels. Now, in real terms, it's going to get there. It's already there. The Dow is at 300 in terms of gold. I mean, think about that. It's not at 3,000. It's not at 3,000. It's at 300. So if we stayed on the gold standard, the Dow would be currently 300, and everybody would know we've never had a bull market, or certainly since 1999 when the Dow gold ratio topped out. So, when you say, could it go to these numbers? Well, yeah, but unfortunately, we've got human beings with their hand on a throttle that can say, well, let's make a few more trillion of these things. Let's make a quadrillion of them. We don't care. And then, of course, they'd say, well, it never got to 6,000. I'd say, yeah, well, it really did. You just couldn't see it. So there are nuances that we're not going to try to get too fancy with. But I do believe that I don't think it's an if, I think it's when we get our debt implosion and junk bonds go to zero, and many corporations are going to go out of business. A lot of stocks are going to go to zero. We're going to have a debt implosion at that time. And I think even in dollar terms, we will have a significant history-making fall in stock prices.
I want to talk about this now. So this is from 2009. This is just a standard hypothetical model for the elite waves of the stock market. So I have it there as 2025. Doesn't really matter, but sometime in the next couple of years from 2009. And this is from the 1800s. So I put my red arrow there. Again, just a bit of fun. I think people might find this interesting. So I put my potential as to where we are now. Where are we in the big picture from 1800s? There is a 1929 crash and then 1932 low, and there we are. My view is that we could potentially top, if not this year, the next year or 2026. But you're more expecting. I think your view is that we're already in the very final stages, right there in the final wave 5, right there. So
yeah, right or wrong, and we've felt it for a while. We think we're right at the top.
And one final question about the stock market before we go on to the next one, which is how long could the next major bear market last? I mean, I'm assuming it's going to be some kind of ratio of the bull market. So some kind of a Fibonacci ratio of the previous bull market. So I'm assuming at least it could last a decade, right? I mean, 10 years.
Well, you see where your bottom is on the lower left of your chart. That was 1784. The peak prior to that was 1720. So the
right.
Green Super Cycle Wave 2 lasted 64 years. That's a long time. As you said earlier, and we discussed second waves versus fourth waves, and that second wave was a zigzag. So this fourth wave is probably going to be a triangle or a flat or a double three, which means it's going to last longer than 64 years. I think it's going to last about 100 years of time when people are like, how could we ever believe so much in the stock market?
Yeah.
Back then. And it'll be, people will go back to work and they'll do things that are practical and valuable to do for their fellow man instead of moving money around. So I think it's going to be very, very long. However, there's an interesting phenomenon, which I pointed out. When the stock market got made a top in 1835, it went down to 1842. That was a 7-year drop.
Yeah.
When the stock market got even more hyped up in 1929, it crashed into 1932. That was 3 years, less than 3 years.
Yeah,
so
yeah. That's
shorter amount of time, even though it was a greater overvaluation. In 1720, it was a South Sea bubble, they called it. The market crashed from 1720 to 1722. That's only 2 years. And that was a grand supercycle top. Now, that was only wave A, but it was still an amazing drop.
Yeah.
So I think this being the biggest one of all, the downdraft could be stunningly swift, like a year or two for the A wave.
For the A wave, right.
And that's one reason why, the central bankers and all the wise guys who passed laws in Congress so that the government can lend and guarantee more loans will be caught so flat-footed they won't know what to do, and they'll be like a deer in headlights, and we'll just get the whole thing over in a very fast situation. So I think those are what history is telling us. The future is a whole other matter. We don't know what the future is going to bring, but studying all the previous collapses, I can tell you that this one is set up to be very, very swift.
I think that's a very good point about a big A wave down, like it happened in the 1929 Wall Street crash, October 1929. Big move down in the A wave, then a fake rally in a B wave fake rally, which gets everyone bullish again, and then boom, C wave, very deep, very devastating and painful C wave, taking a significantly lower. That's about right? So it's something like that.
Well, yeah, I mean, my guess it'll be a triangle. I've kind of mapped it out as a puzzle.
Oh, okay. Interesting. That's really interesting.
C waves is often very, very swift. And in flats, it's the C wave that's swift. So I think the A wave is more likely to be swift, and that tells me it's more likely to be a triangle.
All right, guys, make sure you go ahead and join Bob's newsletter, Bob Prechter's newsletter. That's his financial forecast service, which includes his elite wave theorist and the financial forecast and the short-term update. By the way, you get access to all of this for only $7 for 1 month trial. Go ahead and check it out. I'll put the link for you guys in the description. Again, that's elitewave.com/Alessio. I'll repeat it again. elitewave.com/Alessio. You get access to everything. Bob, thank you very much indeed for once again agreeing to do this webinar. And thank you so much for being a sport and staying longer than we agreed. I really want to thank you one more time. I appreciate it.
My pleasure. Have a great rest of fall.
Cheers. Thank you very much, Bob. I appreciate it.